Hello, everyone. Welcome to one new episode of Mundos e Fundos. This episode will be full in English. Se você quiser assistir ele em português, ele está sendo transmitido agora também no YouTube da XP em português. My name is Nathalia de Sá. I'm a part of the investment team of selections and DNA funds. And today, I have a pleasure to have Daniel Vargas with us. He's the portfolio manager, one of the portfolio managers of the strategy Moneda Latam credit advisory. And I would just, as usually, I will start showing some PowerPoint presentation to you. Just 1 second. And good night, Daniel.
Thank you, Natalia. Thank you for inviting me. I'm very happy to be joining you guys in this event. Thank you.
This is our pleasure. I guess you are ready. Seeing my screen. So as usually, I'll just showing you. If you want to watch any of the previous presentations, you can just scan the QR code with your camera's phone. In here, there is 3 ways that you can invest in Moneda Latam Credit Advisory. One is directly in the fund. Second one, you can invest through selection Renda Fixa Global. That is a fund of funds that invests in the best fund of funds that are focused on bonds, global bonds. In the case of Moneda Latam bonds, and the third way, it's by a DNA fund, that is português rapidinho, mas acho importante essa parte. Então, assim, pessoal, vocês podem investir direto no fundo, é importante dizer que ele não tem exposição cambial, ou no selection, né? Lembrar que o selection tem o selection de ações, que investe nos melhores fundos de ações. Hoje a gente lançou o selection renda variável global dólar, então tem vários fundos de renda variável global dólar, e os DNAs que são fundos portfólios, né? Então, em um fundo só, você tem acesso a todas essas estratégias. And returning to English, and the last slide. So one thing that it's important to say here, of course, we look the performance of the funds, but we don't think it's very right to look at if there is just a short period of time. So what I'm trying to show you here is what we have. So XP and Moneda, we made a very exclusive fund that we just have here that combines two very good strategies of Moneda. So it's 60% of this is invested in this fund here, Latam Corporate High Yield, and 40% is invested in investment grade assets. So this fund has more than 20 years of track records, as you can see here. And the strategy here is it's compounded year, yeah. So here it's almost 3% more than the benchmark, and in almost 5%, no, more than 5% each year, more than global high yield of JP Morgan. So it's a very good performance. But I'll let Daniel talk more about the other part that for us it's very important. And again, thank you, Daniel, for accepting our invitation. And it's very good to be here with an asset and a portfolio manager that has such a long track record and such a good history.
Sure, Natalia. Thank you for inviting me.
So if you could start talking a little bit more about your background.
Sure, absolutely. I've been with Moneda for over 15 years. Actually, I was Moneda was my first job after graduating as an engineer. I'm an engineer from one of the universities here in Chile. So actually, I started working. I was the first analyst working for that fund that you were showing. Our high yield strategy. We launched that strategy almost 21 years ago. When there was not even a benchmark for that strategy. So we've been around for quite a while. As I said, I was the first analyst. I'm an engineer. I'm a Columbia MBA graduate as well. I'm a CFA. I've been working for more than 20 years in financial markets. I've been always working in financial institutions, 15 years at Moneda, 5 years in a company in New York. So always looking at companies. I've been a credit analyst most of my career. Also, I was an equity analyst while I was working in New York. And I've been portfolio manager in Moneda, working on our credit strategies for the last 5 years. So my background, my professional career has always been related to at looking at companies, understanding business models and finding good investment opportunities. So my career has been always related to financial markets, and while at Moneda, it's been always looking at Latin American companies. So that's our focus, and that's what I've been doing while at Moneda.
Yeah, it's a long history, right? You're like almost now 30 years of Moneda that just focus on Latin credit, and the portfolio managers team. You have like something like 18 years on average of history, right?
Right. Yeah, sure. I mean, yeah. But I mean, all the PMs here, we've been around for many years. I mean, we believe that having a very experienced senior portfolio management team is very important to really finding and make good investment opportunities.
Sure, that's amazing. And could you tell us a little bit more about the asset management company history?
Sure. Moneda was founded in the year 1994. So we have been around for 27 years. We started with a Chilean small cap equity fund in the year 94. That was our first strategy. Today we manage directly close to between $8 and $8.5 billion in assets directly. So we are more than 2,000 employees, 10 partners. We have offices in New York, in Santiago, and in Buenos Aires. So we are managing today close to $4.5 billion in Latin American corporate credit, meaning we only companies debt of Latin American companies. So we are probably one of the $1.5 billion. So we are probably one of the largest managers of this type of funds in Latin America. We also manage around $1 billion in LATAM equities. We also manage $1 billion in Chilean equities and another $1 billion in other types of assets. So we get to those $8.5 billion in total assets managed directly by us. So as I said, we started in the year 94. Then we launched the strategy that you were showing in the year 2000. It was our high yield strategy. It has had an amazing performance, more than 11% per year in dollars. Then a little bit before of the financial crisis of 2008, we launched our LATAM small cap equity fund. Shortly after, we launched a Latin American corporate debt fund in local currencies. That is it's also a very unique strategy. And then we launch, we've been launching a lot of funds after that, LATAM large cap equity fund, then some private debt funds. We also launched an investment grade LATAM corporate fund in the year 2015. And last year we launched this new fund with you guys, which is a fund that is going to be doing a mix between high yield, that today is around 60%, and investment grade, that is 40%. So it's pretty much covering the whole spectrum of LATAM corporate bonds that you can find and buy in the region. The reason for combining those asset classes is in order to have liquidity, in order to offer a product that has a daily liquidity. So we're combining those two strategies to create this fund, and we created a special share class for XP clients that is hedged into Brazilian reais to avoid the exchange rate volatility. So it's the same fund that we have in dollars, but with a hedge into Brazilian reais, so there is no exchange rate volatility. So your clients can access that fund directly in Brazilian reais. So we are very happy about this new partnership that we did with you guys. Actually, our asset base client base is mostly institutional, and we are starting this new partnership with you guys in order to target individuals, to target your clients. So it's a new endeavor for us. We're very happy that you guys selected us in order to do this partnership, and also something new that happened early in September. Just to finish the history of Moneda, is that we announced a business combination with Patria Investimentos, that is also a Brazilian company, a private equity manager, very well known, very institutional company that is extremely complementary to our business. I mean, there is very little overlap of clients and products. They do mostly private equity. We do equities and public debt. So there is very little overlap in terms of products and clients. So it's extremely complementary combination, and we are very excited. And I think that's also going to help investors in all our funds, because we think we're going to be able to grow those funds and become more relevant in order to do business. So we're extremely happy about that. So I mean, we're growing. I mean, and also, I mean, it shows that we in Latin America, we are being able to integrate with other countries, companies, with Brazilians through the partnership with you guys, with the business combination with Patria. I mean, Chile and Brazil, and hopefully other countries or other companies from our countries in Latin America also, join us somehow, and we start having a more integrated financial market in Latin America.
That's great news. Very good. Now we are getting into the cockpit.
Okay.
Cockpit, yeah. And then I would like to ask you if you could explain more about how the investment process works. So now we have a combination of two funds, but how do you pick an asset for in each of them?
Sure. But our investment process has been developed over many years. As I said, we are 45 investment professionals at Moneda. We're extremely bottoms up. So we look at, we've been around for many years, so we pretty much know every single company that comes to the market to issue a bond. We look at everything that comes to the market, and every company that comes to the market and tries to issue a bond, we analyze all those opportunities. And obviously we have an investment framework that we believe helps us to select the companies that we think are going to do better, that we have learned also over the last 20 years that work better in a fixed income portfolio. So I'm talking about companies with predictable cash flows, real assets. Hopefully, for credit, it's very nice to have, for example, regulated business with contracts. So we have an investment framework where we look at the competitive advantages that the companies have. It's always good to have bonds from a company that has a sustainable competitive advantage. We look at the business model of the company, the pricing power, if the market is a price taker, or the company has pricing power to set the prices, growth prospects. I mean, if the company is growing, obviously we look at the capital structure of the company, where this bond that we are buying sits within the capital structure of the company. We have no problem being in the junior part of the capital structure, as long as we are being compensated for that risk. So we look, obviously we like to be to buy secured bonds, secured by assets, but obviously sometimes bonds are unsecured. So obviously we like to be compensated for that risk. We look at the cash flow volatility of every single security, the refinancing risk, the liquidity, how the maturity of debt of the company looks like. We look at the valuation, obviously. As I said, we like to be compensated for the risk that we're taking. We don't like to be invested in bonds that depend on single events, right? So we like cash flows, continuing cash flow, not a single event. And we like companies that have real assets, and that we feel that the recovery, in case if things go wrong, the recovery is going to be high. So by saying that, we avoid companies with a lot of intangible assets. And also lately, it's been we look at the covenants. We take a deep look at how the covenants of the bonds are set. The collateral, if any collateral is being made available for us. And something that is becoming extremely important lately is ESG factors. I mean, environmental, social, and governance factors. Bonds, I would say that 1/3 of the bonds coming to the market are ESG or sustainable link bonds with some KPI. A lot of bonds are coming to the market with targets, with social target or environmental target that companies need to fulfill in order to get a reduction on the interest rate. So that's becoming very common. I would say that 50% of the Brazilian companies that come to the market are coming with those features. So we look at that. Obviously, it's very good, very nice to be invested in companies that are putting themselves social and governance or environmental targets. We have it internally in Moneda, an ESG team as well. So we ask companies what they're doing on these factors, environmental and social factors. So we send them a questionnaire. Sometimes companies don't have really an ESG policy. So we push them to develop an ESG policy. That's becoming very important. Our funds are not ESG per se. I mean, but we think it has to be embedded in the investment process. I mean, we have a responsibility to put our clients' money into good use. So this is becoming much more relevant, and obviously we want companies to be putting also these targets, social targets, into their business model. So I would say that summarizes a little bit our investment process. Obviously, we look to, just to finalize on this point, we try to avoid permanent capital losses. So that's why we look at we have that investment process. So we try to diversify the fund as much as possible in order to avoid events, because when you are investing in high yield, sometimes bad things happen. I mean, it's part of being investors in high yield securities. So investment grade securities usually don't default because they are investment grade for that reason, because they are very secured. That's 40% of our fund. But the other 60% is high yield, and high yield sometimes bad things happen. So it's important to have a diversified portfolio. We have a limit up to 10% per issuer. And we are always very far away from that limit. Rarely we go above 5% per issuer. So we try to run the fund very diversified. We have a risk team that is always looking at our exposure per country, per issuer, and type of security. So we're monitoring the liquidity of the securities as well. As I said, this is a daily liquidity strategy. So we need to make sure that the fund is liquid, right? We don't like to have to see redemptions, obviously, but sometimes it happens. So we need to make sure that the fund is able to comply with that, and so we have a team that oversees that and controls the liquidity, and that we are following, obviously, the investment policy of the fund, the prospectus. So I would say that summarizes a little bit our strategy. Our fund is regulated by our fund. The master fund is listed in Luxembourg. So it's regulated by the Financial Authority of Luxembourg, and so as a company, Moneda, we are based in Chile, so we are also monitored by the Chilean financial agency. So we have agencies that are monitoring us as well.
And the Brazilian fund has its agents too looking into it. That's
absolutely
good. That's good. And what about your best flight or the fund best flight? Is there any position that you could tell us that was a successful one?
Sure. I mean, we've been.
You like to highlight?
Sure. More than our philosophy over we learned a lot over the last 20 years investing in Latin American corporate bonds. What I can say is that we prefer to invest in certain sectors. We like infrastructure. We like industrial companies, utilities. Why? Because those companies usually have contracts, stable cash flows, and visibility into those cash flows. We like regulated sectors like utilities, like electricity companies, for instance. Why? Because they have a regulated business, and sometimes those revenues actually are in dollars. So there's no currency mismatch. So over the years, we have learned that we need to avoid the currency mismatch and to have as much cash flow visibility as possible. So that we have the tendency we have developed over the years is to look for companies where cash flows are as predictable and visible as possible. And we also look at asset price, the type of assets from these companies, that real assets that have value, because we're also always obviously thinking about a worst case scenario, what the recovery could be. And the recovery depends obviously sometimes in companies selling assets. So we like to understand the asset base of the company and make sure that asset base has a value that protects us in the downside. Okay, obviously, right? So we look at the type of assets below the company, and we have something that I didn't mention before. We have a special. We have a team of analysts looking at sector and companies. We have a team of analysts looking at ESG, but we also have a team of analysts looking at distressed situation, our restructurings. Companies that go into trouble and they need to restructure and negotiate with creditors a new capital structure, right? And we have a dedicated team for that. So we've learned a lot also from that. And I would say that some of the best ideas and best performance in terms of returns that we have had over the last 20 years have come from restructurings. For example, like I mentioned that we invested in Cemex, the Mexican cement company, in the year 2008. After the financial crisis, the company was very highly levered. As you remember, property developers in North America were suffering after the subprime crisis. So the property development came to almost zero. And so Cemex was suffering a lot from that. But what we saw real assets, plants that were producing cement. We knew that the market was going to come back at some point, that Cemex is one of the largest cement producers in the world. And we thought that the management of the company was a good management, very professional, and willing to negotiate in good faith. So we decided to participate in those restructurings. We bought some debt from the banks that were restructuring those bonds. We bought some bonds in the secondary market that were secured. And at that time we were buying, it became one of our largest positions in those years. And bonds were yielding between 15 and 20%, amazing yields. And for a company that we thought it was a market leader globally, well managed, but it was going through a tough time. And we made quite a big, we never sold a bond. The company kept, obviously the business started recovering. And as the business recovered, the company started buying back those bonds and reducing leverage. It took the company Cemex longer than expected in order to reduce that debt level. But we knew that the company was worth it, and we made an amazing return from that company. And we never, as I said, we never sold the bond. The company kept buying back, calling those bonds, and today Cemex is small allocation to within our funds today, because the company has been coming back to normal. They're not investment grade yet. They have a target to become investment grade at some point. It has been taking them a long time, but it's going in the right direction. Today the yield is low for us, so that's why we have a very small allocation to Cemex, but we still believe it's a very good company. But I think what it shows, that investment, is that when you really look at the asset quality of the company, the competitive positioning of the company within the market, the company being critical within their sector, within the industry, usually it is a good investment. And what is nice of when you look at Latin American corporate bonds is that most companies that you see coming to this market are that type of company, very large, market dominant within their sectors. So I think that's a very nice case where we made a very good investment, and I shows a little bit our investment process and how we select things, and the type of things that we're looking at when we're looking for opportunities.
Yes, it was very good illustration, and in fact, a very good case. But they're not just good cases. And I'd like to ask you to talk about an emergence lending. So it's a position that that didn't do as well as expected.
Sure. I mean, obviously, we've learned over the last 21 years from some mistakes, and it's the opposite to what I've been saying. Sometimes when a company, I mean, something important is the character of the owners of a company. Something that is very important. We need to make sure that we are investing in companies where the owners are good people, decent professionals, and also companies that don't have a lot of intangibles. That especially when you're looking at financial institution, not necessarily banks,
but because it's hard to measure the real value. That's why.
Right, because it's hard to measure the real value. Sometimes companies hide things within those accounts in intangibles. So that's always a red flag when we see large intangibles in the balance sheet of a company, and it's something that we need to avoid, especially when a lot of companies, not necessarily banks, lend money. When you look at retailers or some non-bank financial institutions like credit companies, not necessarily banks, you need to be very careful with those type of companies on how they provision for credit losses. There are retailers that lend money to their customers, right? So they always have this issue of what is more important for them, to sell products or to lend money to their customers. So, and those companies usually are not banks, and the accounting that they use is not bank at the standard of a bank. I think you need to be careful with those type of companies. Always be very cautious and question every single account. We made mistakes on those over the last 20 years. We have learned from that. So obviously we use that knowledge to it doesn't mean we don't invest in that sector anymore. We just use that knowledge, that experience to help us finding opportunities and fully understanding what we're doing in those sectors. And in order to avoid to mitigate the risk that we're taking by doing that, that's why we have limits. The 10% limit per issuer that was mentioning, we usually don't go above 5%. It's usually 10%. 5%. The higher that we go, probably the average position that we have is around between 1% and 2% of the portfolio. So that way we avoid big surprises, and that's why I think it's important for clients to I think investing in high yield is extremely important in order to have a well diversified portfolio, but it needs to be diversified because there are blow-ups in high yield. And the only way to have a very well diversified portfolios is through managers, through specialists. So that's why I think that we have a good product, and that's why we have many companies and bonds within our portfolio. Another thing that we avoid are some commodity names, like highly levered commodity related companies. Why? Because they are price takers. They sell commodities. So a company that is today, for example, has leverage of 3 times, let's call it 3 times net debt to EBITDA. That's a metric that we follow a lot in order to know how much leverage a company has. If the commodity price drops in half, the leverage is going to double, right? And it's not the company's fault. So that's why we try to avoid highly levered, pure commodity related names, and we focus more on industrial, infrastructure, utility names. So we've learned from these situations in the past, and so we have these biases that we think of when we are putting our portfolios together.
Great. So we talk a lot about past. Now let's talk about future. And if anyone in the audience want to send us some questions, please feel free. So let's talk about scenario. I would like to understand a little bit more what is your view about that in Latin America, of course.
Sure. I think that Latin American corporate bonds should be like a core holding in international portfolios for clients. Obviously, every client has a different risk tolerance, so the percentage that you should be allocating into emerging market bonds, it varies. And I'm sure your client can talk to your financial advisors at XP and find out how much percentage of your portfolio should be allocated to emerging market corporate bonds. But I believe this is a very novel asset class that should be included in portfolios. When you look at LATAM corporate bonds over the last 20 years, they have performed between 7% and 8% per year. You showed in your slide that our high yield fund has delivered close to 11%. but which is a very good performance. But also when you look at the asset class, the universe, it has delivered between 7 and 8, which is also a very nice performance, right? So I believe per year in dollars. So I think that's is a very positive return that you've seen in the past, and going forward, yields have been coming down, so expectations into the future are a little bit lower. But for example, our fund today, the yield to maturity of our fund is close to 6%. It's a little bit below 6%. So we expect with a duration of 5 years. So that's our fund. The universe is yielding below that, is closer to 4.5% per year in yield. But anyway, I mean, in today's low rate environment in dollars is quite a nice yield going forward with 5 years of duration. So I think it's a very good asset class to own, to add diversification to your to fixed income exposure. And why is that? Latin American also, there's always political noise in Latin America, and that helps to have higher yields. We've been investing in Latin America for 20 years. Almost every year there's political noise in a country, right? And always it seems that it's the end of the world, and the country is gonna go into a crisis, and usually political noise goes on, and the economics start to improve in the countries, and that's why it's important to invest in good companies. Is something that we do, and companies that are critical to the economies, and companies that are able to survive whatever government they have to deal with. So that's why it's critical to select good businesses with a stable cash flow. So we believe that Latin America is going to do well. We don't expect the 8% return per year that we've seen in the universe in the past, but we think that returns between 5 and 6% going forward is very reasonable. That's just to give you a sense, that's in a spread of around 450 basis points over treasuries. When you swap that into Brazilian reais, which is what your clients have, you get something like, it's not the same, but CDI plus 400, call it, if you take into account the hedging cost. So obviously that's our expectation in terms of returns going forward. In the medium to long term, obviously in the short term, there can be some deviation from those returns because there is volatility. That these international bonds have volatility. Prices go up and prices go down depending on risk appetite of the market. When we started the fund with you guys, we were targeting as well CDI plus 400, between 400 and 500, and we have delivered more than that. We have delivered CDI plus 600. So we are a little bit above what we expected. Obviously, I cannot assure that we're going to keep those levels, but I think going forward, the expectation of CDI plus 400 hopefully is achievable in the medium to long term with these current spread levels that we're enjoying in the dollar corporate bond market. So I think that's reasonable to expect. There is going to be noise. So your clients need to talk to your financial advisor and to feel comfortable with seeing more volatility. This is fixed income that has price volatility. It comes up, it goes down. But something interesting when you look at this at the universe, as I said, it has delivered close to 8% per year over the last 20 years, 19 years, sorry. Only in 4 years, it's been negative performance during the year. And 15 years, we've seen positive performance. But there are some years that you could see negative performance because it's a more volatile type of asset class. But so that's why I believe it's a core asset to own. And usually when prices go down, nobody likes to see the NAV of a fund coming down, right? But the beauty of this asset class is when prices come down, the yield of the bonds increases. So the probability to recover that loss increases. And it's a feature that is pretty nice for high yielding securities, and that's why I think it's a very novel asset to own. And just to finish regarding this, it's a big market. Sometimes people don't understand how large this market is. Is more than $600 billion worth of bonds, the Latin American corporate bond market. We're talking about around more than 1,000 different bonds, 350 different issuers that from Latin America that come to this market. We're talking about large companies because in order to come to this market, you need to issue at least $500 billion in debt in a single bond. So only a large company can come to the market with such a large bond. So we are always talking about very big companies. We're talking about very large companies within Latin America, market leaders. Is the number one, the number two, or the number three player within their sector and their industries. So that's why these companies survive whatever government they have to deal with. They survive whatever political noise there is around. So that's why we think it's a very interesting investment opportunity.
Yes, that's good. She gave us a very important structural informations about the sector, and that's very good. But I would like to highlight two things that you told us. One is the spread over treasury. So yeah, I agree that it's a very important class to have right now, because when you look the other bonds or other sectors spreads over treasury, so I don't know, American bonds or other developed country bonds, this spread over treasury, it's really low, and it's already actually lower than were before the COVID crisis, and we'll still have good spread over treasuries here in Latin America. So that's a good point. Another thing that you told that I would like to highlight, because there is a lot of discussions here in Brazil about Selic and where it's going to go, right? The Brazilian interest rates. And when we buy hedged funds, the ones that doesn't have exposure to the foreign currency, right? We actually had benefits investing this, because we receive the interest rate of Brazilian Selic, and we have, of course, to pay interest rate of the other country, but it's a very good asset to have those invested funds, hedge funds. Actually, we talk about this in our last DNA letter for the clients. So it's nice that you mentioned.
Sure.
You talk about you told us a little bit about ESG in your fund, and now it's a subject that we're talking a lot in Brazil. So what I understood is that it's not like an exclusion thing, but you take it in consideration like another criteria or something. Like, if you could talk a little bit more, and if you are like those investors that are talking with the company and they're doing like some pressure to change things, it would nice to understand.
Sure. We don't use. We were one of the first companies to be to be adopting some ESG practices. As you said, we don't use. We have a dedicated team for doing ESG analysis. we don't have an exclusion list. So the idea is not to blacklist any company per se. Obviously, we want to be part of improving the market and helping companies to be more socially and environmentally responsible. And we also know that this is an early type. We're in early stages of development of this, so we need to be proactive and talking to companies, but not using this as an exclusion mechanism. So we really want companies to improve, and we want to be able to finance them as well and help them in that transition. So that's why we think it's very good that we're seeing sustainable link bonds coming to the market. That's something interesting. A sustainable link bond is a company that sets itself, for example, an environmental target, let's say to reduce carbon emissions. And they hire an agency to monitor that reduction in carbon emission. And if they don't meet the target, the interest rate increases that they pay to us. So if they meet that target, they are not penalized. We like that those type of bonds it doesn't need to be only about carbon emissions. Actually, for example, a Brazilian company, B3, the Brazilian Bovespa, right? They issue a bond that one of the KPIs is to increase the number of women within the board and executive positions. That was the KPI, right? And we invested in that fund. So it doesn't need to be only environmental criteria. It can be social criteria. And we like that, and the idea is to be able to support companies that are moving in the right direction. We also want companies to put themselves with challenging, obviously, targets to really make a good impact. But the idea also as well is to be able to be flexible, and there are companies that are coming to the market without these targets, but we still want them to move in the right direction. And we are looking. We run analysis on ESG. There are like 100 different factors that you can look within ESG for a company. And so this team, what it does, they talk to the company, they exchange questionnaires with the companies, and so we start looking at the idea is to look for risks that might be underappreciated by the market. There are companies that have a lot of casualties, a lot of accidents within their workforce, and obviously for us is a red flag, and we want companies to improve. So we are constantly talking to these companies and making sure that they are developing policies and improving the way they deal with society and their employees, right? So I mean, the idea. It doesn't need to be a sustainable bond for us to be doing work with the companies in order to be improving the governance and the ESG factors of a company.